The greatest investors don't worry about winning. They make sure not to lose. So, today we're going to be talking about what is margin of safety, where did it come from, how the greatest investor, Warren Buffett, has applied it, how you can apply it, the psychological principles behind it. Can it be applied to more than stocks? Is it still relevant today? And some insightful wisdom from the greatest investors about margin of safety. So, what is margin of safety? It is the process of finding the intrinsic value of a company and buying at a discount to that. So, we'll look at intrinsic value later and what that discount means, but a brief summary is intrinsic value is the cash flows of the future of a company discounted back to today. Then you discount that by 30, 20, whatever you want your margin of safety to be. Margin of safety itself is how accurate you think you're going to be, or an amount below what the intrinsic value of the company that you would like to purchase at. So, where did it come from? It was invented by two men, Graham and Dodd. These were two professors at Columbia Business School back in 1929 while they were teaching a course on value investing, the first of its kind. Graham is the author of The Intelligent Investor, where he also writes about this principle in chapter 20. And Dodd and Graham wrote Security Analysis, the basis of value investing for even to the current generation. So this was built out in the Great Depression when they saw every stock fall by 80 to 90%. But some stocks fell significantly less, even if they were dragged down by the total market. These are the stocks, and if you bought a stock at a 30% discount and it only fell 30%, you would still be in the clear. Unlike if your friend had bought probably today a company like Tesla and it fell 90%, they'd be out of it, where you would still be equal into what and be in a good shape for your investment. So, what else can we learn? Well, one of his greatest quotes is, "The function of margin of safety is, in essence, rendering it unnecessary for an accurate estimation of your intrinsic value." What I take from this is, yes, intrinsic value is important, but if you're significantly lowering the intrinsic value of a company, then you are very likely that the company will recover, if not exceed, your expectations. And even if it doesn't, you'll still make the difference between where you bought it and even a lackluster performance. So, how is Buffett use this principle? Well, obviously, before Berkshire Hathaway, his holding company that he currently is running, there was his partnership, where he would invest in cigar bud companies that had one last puff, weren't great, but could find a profit, normally nets, or negative book value, more cash on their balance sheet than debts. So he used this principle for valuing a company in companies like Apple, where he bought at 39.7 PE ratio he bought at a discount at a 10.2 PE ratio and an earnings per share of 2.15 and a price of 21.88. So, what is Apple at now? Well, as Apple has been one of Buffett's greatest investments, its PE ratio is what I'd said before, 39.7, when earnings per share of 6.30 cents, $6.30 at a price of $250. So roughly, let me think, like a 135% increase, which is 1,300% increase, which is just incredible to think about. So, obviously, that was Apple's been a great investment, and that was one of the best uses. But sometimes margin of safety can be ignored, and this is why it should never be. In the Kraft Heinz merger, Heinz was bought previously by Berkshire at a reasonable price, but the merger significantly overpaid for Kraft. And even within the first month or two, you could tell that if the market didn't change significantly, the merger would be a significant loss for the next few years of Berkshire. So, what else? As we said, our next thing we're going to be looking at is how you can calculate it. So, what you do is find the intrinsic value. But how do you do that? So, look at the company's revenue, EBITDA, operating earnings. You want to give a modest, probably 5 to 7% growth rate, either up or down, depending on, obviously, your NVIDIA would be higher, and your T-Mobile would probably be lower, just depending on the company. Then you want to use a reasonable discount, not too low, so something like 8 to 10%, and apply a a multiple for the end, roughly slightly lower than currently. So if it's currently at a 15x PE ratio, let's say at 14 or 13, and if you're going off EBITDA, sorry, I'm going off EBITDA, 15%, 50 times revenue. I don't even think NVIDIA trades that high. So 15 EBITDA currently, then you'd be looking at 14 or 13 in the future. And if you're looking at revenue, if it's 1 or 2, then go to 7.5 or 1.75, somewhere in that ratio. And you obviously want to be able to stress test the cash flows. What would happen if the business had a significant shrinkage or there was negative effects? This is really where margin of safety comes in. It's like when something unpredictable happens. So the opposite of this are normally the biggest mistakes. When you invest and you overdo your predictions, like you think Amazon will continue growing at 15% instead of lowering those assumptions down to 10 or 9 or even 7, and you put a discount rate of 5%. This mistakes that everyone makes their first time, but we want to avoid these. Okay, the psychology behind margin of safety. So first, why do people overpay? People start overpaying normally when things are either going way up or way down. They're influenced by fear or greed, and whichever one. If it's greed, it's normally stocks are going up so fast and they see all their friends or all the people that they know are getting rich super fast, and they lose their fundamental thought. They don't look deeper into it. And as Charlie says, people overweigh recent outcomes. So here are some of the key biases that come into play. Obviously, you have recency bias. What happened yesterday? What happened this year? That's what you think about. You don't think about every 100 years or how will every few 1,000 years a country falls or multiple countries fall. That's not what you're thinking about. You're thinking, sure, this year tech doubled, so obviously I should be investing in tech because next year it will double. But almost never has that happened. And when it has happened, it was it was the 2001 bubble, tech bubble, and almost half those companies got wiped out. Your other biases are obviously your confirmation bias, and when you believe something, you hear other people talk about it, and you find people who think the same way as you. Just the rabbit hole effect and all that. So the bottom line is a margin of safety sort of protects you from your human biases and your human errors and judgment, while keeping you. And investing is not. It is logical, but it's not what your brain's programmed to do. So it's not a behavior. It's a trained behavior, not a habit or an instinct. So, how can we apply this beyond stocks? Well, you have real estate. You can do pretty much the same thing. Never want to be paying the full price that you see on a real estate website. You want to be paying less than you believe it can make either, or what you think it's worth. This is obviously downside protection. Think about 2008, the financial crisis. So many people lost their houses. But if they had a margin of safety, they would have been able to weather that storm. When it comes to private equity and startups, you can never really value it, especially a startup. Like, how do you know if this startup will succeed, or if it has a long-term vision, and if the ideals work, if it has a clear exit, especially if you have no clear exit pathway. So smart VCs normally have hundreds, if not thousands, of investments, hoping one will be the next unicorn, and that'll be the one that pays for all the failures. And with private equity, you could probably value it, but it becomes harder when you're less liquid, and most companies, they're gonna try and sell either at an auction, or obviously you can find cheaper deals depending on the seller. With business strategy, obviously many companies have grown through acquisitions, Berkshire Hathaway probably being the one you think of most. If just keep it the same, you want your 10, 20, 30% margin of safety. Could be slightly lower going into your 20%. Still, if you'll have some synergies, and maybe you can make it more efficient. But this is obviously, you want to protect from inventory problems, supply problems, obviously if you're changing management, you never know what could happen, so you want to be protecting yourself. And in everyday life, like, think about it, if you have a really important meeting or an interview, you want to be there early. You want 30% protection. It's all the same. It's a key principle for life. Like, it's not just financial, it's in everything. It's strategic. Obviously we're talking about it today. It's still part of today, and we all have our new tech stocks. You have your AI, your Nvidia, AMD, Palantir, super high earnings but very risky, and all of them projecting perfect growth, no problems. Has that really ever happened? No. It's there's always been some problem that comes along. So these stocks that are priced to perfection, they normally, they'll do okay if the company succeeds, and they can go very poorly for the investors. Again, in 2021, PE over 100, earnings complete slowdown with the pandemic. Like, you never know what will happen. We have seen some higher inflation recently, so if anything, your discount should probably be higher because it's taking in both inflation and risk. So yeah, maybe if you were going to put an 8 or 9 on it, put a 10 or an 11% discount rate on your investments, and just monitor the situations, do your own research. I'm obviously not a financial advisor, and this is not financial advice, just for educational purposes. Next, we'll talk about now we're going to talk about some timeless wisdom from time. It's okay. On to timeless wisdom. So, what have we learned so far? We've learned margin of safety is a principle that protects us against errors in our calculation of intrinsic value or unforeseen events that we couldn't predict. So it was developed by Graham and evolved through Buffett, it's still used today. And here are some places you can find more information about it. Obviously, as I said, The Intelligent Investor, chapter 20, specifically on margin of safety. Anywhere in security analysis, it's the backbone of value investing. If you can get your hands on it, Margin of Safety by Seth Klarman is an amazing book, but it retails on Amazon for around $1,000, so I don't even have that one yet. What else do we have? Oh, Poor Charlie's Almanack, amazing book, both on margin of safety and just mental models in general. So much you can learn from him. And here are some quotes to end us off. Obviously, the essence of investing management is management of risk and not the management of returns. From Buffett, you don't have to swing in every pitch. Wait for the fat ones with margin of safety. Seth Klarman, the best investors don't target large returns, they focus on risk first. And Howard Marks, you can't predict, you can prepare. So, thanks for listening. At the end of the day, investing is certainly about both risk and return, but when you have high return and high risk, they both cancel out. When you have low risk and high return, that's how you get results like Buffett of his 23% over the long run. I'm making a short course, so comment down below if you'd be interested. It's going to be on value investing in general, and hopefully you listen to my next video on Circle of Competence. Thank you very much for watching. This is Matthew Reynolds.